Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20-25 odd minutes, we'll try and address some of the aspects around the mutual fund investing space. Remember, the budget is still not quite blowing cold, still red hot, and therefore important to dissect some of the changes that have happened there. So we'll try and understand what is the role of multi-asset allocation funds, particularly the ones with a little bit of debt orientation post the changes that have happened in the budget. So that's the first topic on our radar. Our fund of funds making a bit of a comeback. Remember, especially the fund of funds which have got less than 65% of debt would be interesting to see. And what kind of changes do come into your mutual fund investing funnel as a result of the taxation changes, if they do come in? I think all of this, very important topics, and the perfect guest to try and talk about those, Swaroop Mohanty, Vice Chairman and CEO, Mirae Asset Investment Managers in our studios. Swaroop, great having you. Thanks for joining in.
Thank you so much for having me.
The pleasure is ours. Also, Rohin Pagdiwala, founder of Pagdiwala Investments. Rohin, great having you. Thank you.
Thank you.
All right, so let's start off with just this particular aspect of multi-asset allocation funds. And Swaroop, initial thought on the budget and what changes, largely overall broad brush for mutual fund industry, and then this particular topic, multi-asset allocation funds. How does one approach this particular pocket now?
Yeah, I think from the budget, it's very clear and it's been talked about. I think the two discussions that have been very loud have been the capital gains side, and that's the prerogative of the government. I'm a law follower, but I'll watch if it is consistent now. When it starts at the beginning of the term, I would expect this to be pegged for the next 5 years, unless something dramatic change at the underlying. The other bigger one is the withdrawal from indexation. It's a very philosophical, personal thought that indexation brings to the average citizen the knowledge of time value of money. It plays a far bigger role than just taxation. So when you withdraw it, you have to think of the larger implications. So I'm always a big fan of indexation. So when that goes out, one has to sit back and think. And I never thought that, real estate would take that hit, but it's there in front of you. For people who had invested in debt earlier, it's a retrospective impact to them. So that's something which I think should be thought about, is my opinion. I mean, finally, it stays as an opinion. But from a mutual fund perspective, yes, what you're discussing about the multi-asset funds are something which we've always discussed. I mean, I go back to my initial mutual fund sales days when there were these MIPs which had lower equity and larger debt. But irrespective of whatever the investor thinks when they invest, they finally look at returns. So when you expose them a little bit of equity, they always look at the full scale of equity. So whenever we've debated at Mirae Asset, we've always kept it equity oriented. So I'm not the right person to answer on the debt side, but I would suspect that now a lot will happen on the equity side only.
Rohin, coming on this, Swaroop very modestly says he's not the right person, but independent of what schemes are within Mirae, his knowledge far exceeds that, but would want to bring your thoughts here as well. Particularly the debt-oriented multi-asset funds, could there be, should there be, would you tell your clients to make changes because of what's happened in the budget?
Potentially, yes. See, initially, my recommendations were generally equity-oriented multi-asset allocation funds, primarily because there was a big tax arbitrage. Now with long-term capital gains tax off the debt-oriented funds, and debt-oriented being funds which have more than 35% equity, at least, being also 12.5%, albeit the holding period is 24 months and not 12 months compared to the equity ones. So there's a lot more even playing field. So now my recommendations would be based on what the investor's profile is, what their needs are at that point of time. If it's a low risk profile, multi-asset allocation funds, debt-oriented ones are potentially a good option. But if they're open with okay about the volatility and the risk, then I think the equity ones are still the preferred choice.
Because the reason I said I'm not the right person, because we were very clear on our positioning of them being equity. So me saying anything against the debt side would look a little biased.
Fair call, fair call. Okay, and Swaroop, I mean, do any of these changes that have happened lead you to believe that people might want to en masse at a larger scale, make changes to the portfolio per se? So people having a larger portion of debt funds in their portfolio, do any of the taxation changes make one believe that, okay, let's change into an equity-oriented portfolio largely?
Many will be tempted to, but I will advise them not to, because finally the allocation is to debt is a factor of your risk profile, right? Taxation is incidental, right? Your broad portfolio allocation is a reflection of your broad risk profile, and that is what the diversification of different asset classes bring to the table. Now you've made that based on how much of risk you can take. Now you're going to make it, change it because of the taxation. Then you have to go to a relatively similar product. When you're shifting to equity, more equity, you're, the basic risk profile of the portfolio changes. That's something which one has to think extensively because doing that, because you only know the risk when it unfolds, right? And when it unfolds, some very pedigreed investors might get a little unnerved. That's my simple logic to the whole thing. Please think before you move it. It'll change the risk profile of your portfolio.
Okay, fair call. Rohin, sorry, I heard you say that, and then I want to bring in just one question on arbitrage funds as well. But just one question, Rohin. Where within this whole line would you tell investors? Let's assume the investor is okay with the equity versus the debt question. Right? Let's assume that that's the profile. It's not that only 100% equity or only 100% safe and therefore want to be in debt. Does the multi-asset portfolio therefore change because of the budget taxation and not? I'm trying to remove the investor
Personality.
bias or personality out of the equation here.
I think no, because okay, let me get back to what my original recommendations have been, right, which is equity-oriented multi-asset allocation funds in any case. So most of my clients, most of my investors are equity multi-asset allocation funds. Having said that, if somebody comes and tells me, listen, I want a lower risk portfolio, and if I think at that point of time I feel that multi-asset allocation funds of the debt-oriented type are a good choice, a good fit, then I would not hesitate to recommend them now. Earlier, I would have hesitated because the taxation was simply much different. Now, the only thing that's different is the holding period, which, given that all recommendations are generally for the long term, I would not. So yes, it might start creeping into recommendations that otherwise I would not have considered earlier.
Okay. The other aspects, Swaroop, we were discussing this just before we came on air as well, on arbitrage funds. There was a lot of expectation that could there be some taxation changes which will bring arbitrage funds at par with what bank deposits might be, because they were taking rightfully a lot of investors' attention and money for the shorter term, less than 11-12 months as well, when it was a focused time-bound investments.
True.
Now, that hasn't happened, but there is a taxation change that has happened,
right.
Short term, long term.
Yeah.
To your mind, how does this impact arbitrage funds? And are there alternatives within the mutual fund landscape now for an investor to invest in if she or he does not still want to go down the bank route?
See, the beauty of the taxation this time has been there are two figures now, 12.5, 20, right? So that puts a lot of things in perspective. Now, when that happens, then again, I bring back the risk profile discussion to the table. One can look at other shorter end debt funds also, because so it need not be only arbitrage because of the tax advantage which people had. Now it brings a bigger, array of products on the space, and it clearly demarcates the positioning of each product a little better than what it was. That's my opinion. Is that the natural shift or the normal shift to arbitrage now stands a little nullified, and people can view other debt products with their horizons, unless they shift it above a year, for say the shorter end of the curve or shorter end of the products on the debt side become more meaningful is also a good point which you are raising. As we speak, I'm realizing it's a very, very valid point which investors are, especially all the advisors, distributors, have to now think a little more wider.
Is Mahendra Jaju a happier man?
Hey, he's always a very happy man. He just crossed 20,000 crores in debt, so he's happy.
Okay. Rohin, same question before we take that break. As an option for arbitrage funds.
I tend to agree with what Swaroop's saying that in any case, liquid, there are other products in the shorter end of the curve which are, which in any case would have, in my opinion, been better than arbitrage funds in general, liquid funds, short-term debt funds, ultra short-term debt funds particularly. And I think those can continue to remain attractive for a specific reason, for a specific purpose.
So, so I'm just trying to make this clear, sir, Rohin. If somebody was saving through the arbitrage fund route, are you saying that now, instead of using the arbitrage funds, use the short-term maturity debt funds?
See, arbitrage funds tend to have a tactical, I mean, the returns also are variable, right? They're not as predictable as ultra-short funds or liquid funds, right? So they're anyways at times, or rather in steady state cases, slightly inferior in return terms to ultra short-term funds or liquid funds. So typically, if a liquid fund is giving you 6, 6.5, arbitrage fund might give you 4, 5. Of course, there'll be times when it'll give you 7. So anyways, there's a return difference which was being compensated by the tax arbitrage. Now that the tax arbitrage is reduced, I think liquid funds or ultra short-term funds might have a slight edge. We'll have to do the numbers, but I think they'll have a slight edge.
One of the things that's happened, fund of funds, so far treated as debt funds, there's a change now. Does it make this category attractive, for lack of a better word, again? I do not know if you have the fund of fund options, but if you didn't, Swaroop, let's start with you. Does the budget make you think of a fund of funds category because of the taxation changes? Why or why not?
Neeraj, let me tell you, we are very big fund of fund players in the market because when we thought of innovating differentiated ideas on the passive side because of the lack of them on the active side because of the categorization, and we developed some great ideas on the ETF side. And the best way to take it forward to people without the demat account was the fund of funds side. So we have a long range of fund of funds product, and this anomaly of taxation was something which was consistently debated because ultimately it is on listed security or unlisted security that can be debated, but people who are invested in listed security should be taxed at par as equity, right? So it is a big thing for us, especially as a fund house, because we believed in the fund of fund story. When you back a fund of fund with an ETF, then the costs are definitely lower. It brings an exciting story to the wider range of the investor, and through the fund of fund route, you can do a lot of, bundled products also. We run both sides of the business, but I think this is a big change, welcome change for us. In fact, we had launched an NFO very confident that this would come, to be very honest. Okay, the last day was coincided with the budget day, saying that this will come because this was an anomaly, and then maybe due to oversight or whatever, but that's got corrected. But yes, it's a welcome change, and through that process, through that path, we can get a lot of interesting ideas to a wider range of investors.
Okay, so you believe that equity FOFs will now see a much higher inflow relative to what they have,
Should
you reckon?
see, because the ideas are powerful.
The ideas
See,
are
finally a good idea sells, see, fund of fund is just a vehicle.
unless it's not marred by taxation.
Correct. Now, underlying idea has to be good, and we believe that there are some very exciting ideas which are there.
Okay, like?
See, we have done an alpha idea which is very good. The alpha 30 is doing extremely well in the market. We've developed a manufacturing index, and this was 1 year ago. The active side is now launching manufacturing funds, but look at the track record. It's too early for me to speak about performance. But if one were to sit for the next 15 years or catch say, a 15-year secular India run, it is manufacturing. And this fund is available at 30, 40 basis points, right? So that's like very, very attractive, both put together. It can be a very powerful combination, and investors need to see this side, I would say.
Okay, Rohin, you concur?
Absolutely. I've been.
You don't have to.
No, I don't. I know I don't have to. I don't have to. But it's one of the things that I was very happy to see from the budget, because fund of funds taxation at slab rate was an anomaly. It shouldn't have been, especially if the underlying funds are all equity funds and all listed, right? So there is no reason that taxation should have been there. And I echo Swaroop's thoughts completely, because there are so many innovative products that are available even now on the fund of fund sides, which otherwise we could not recommend to clients because of the tax difference. I'll give you an example. The ICICI has a couple of them, the India Equity FOF, the Thematic Advantage Fund, very, very interesting products. The Thematic Advantage Fund is just purely sectoral. All that the fund manager is doing is taking weight from the sectors, and then the underlying fund is, let's say, if he wants to go heavy on pharma, then he just puts 20%, 30% into the pharma fund. That's all that is done. So the management is simple. All we are as distributors looking at is the allocation correct, or is the allocation relevant from the current market standpoint? But there's so much of innovation that you can do on the fund of fund side. It's quite exciting.
You like the Mirror Asset Equity Allocator as well?
As well, yes. Now, the Mirror Asset Equity Allocator is very different from the Thematic Advantage from ICICI. Thematic Advantage makes macro calls based on sectors. My understanding of Mirror Asset Allocator is it takes based on market capitalization. So, simple example of differentiation. Right? That's a diversified fund. This is more likely to be sectoral heavy, so whichever one you prefer. But I think there's so much you can do on you can have fund of funds which are actively managed at the macro level, but passive, the underlyings could be passive, or the underlyings could be active as well. So there's lots you can do, and I'm happy that the taxation has been taken care of.
And most of the fund of funds are rule-based. There's no subjectivity. You know what you're getting, and the rule will unfold. If there's a rebalance day, it will rebalance.
Okay, fair call. The other aspect, Swaroop, is this whole thing around large versus mid versus small, and I would love to get both your views here. Let's start Rohan with you on this one, right? Have you been telling your clients, let's shift out of small cap or multi-cap or mid-cap funds and put into large caps?
Partly yes. I've been requesting or recommending that people move out of small caps, sometimes even out of mid caps, depending on each person's individual portfolio, but not go into large cap funds per se. I'm generally moving them to flexi cap funds or even multi-cap funds. The reason I'm doing multi-cap funds, even though they have a minimum 25% to small caps, is because then you're sort of investing for the real long term. Where the money is really long-term money, then multi-cap funds, I think, still at this point of time also are decent options to choose. But small cap becomes kind of what should I say, segmented, or it's just small caps perpetually, which I didn't want. I wanted the fund manager to have the option to move money within a multi-cap or within a flexi cap. So that's been the shift I've been making.
Okay. So most people who've called the market top have gotten it wrong thus far. And by thus far, I mean the last maybe 12 to 18 to 24 months, it may well be the case, right? True. Because the market has surprised, and partly because of the Indian retail investor, the domestic flows have been so strong. So would it be wrong to call this market as saying that overheated is one thing, but that mid caps and small caps are looking a lot more vulnerable than large caps are? Because almost every fund manager that I speak is now telling me that it's not a nifty story. Now it's a bottom-up stock-specific story, and the markets may well stay flattish, but individual stocks will do well, which tells me that actually a small cap fund might do well because the concentration and the bottom-up story can be picked there, while a large cap fund or a nifty index fund may not necessarily do well. So how do you think about this?
Two parts to this story. Let me start with it's a very interesting time when we are having this debate, because if you look at the last 12-15 months, the large cap funds have beaten the benchmark, the small cap funds have not. So when you look at this story, let's look at it in totality. So it's wrong to write off the largest companies in the country, right? The market cap expansion that can happen of the largest is probably larger than what can happen to the smaller cap, and I can substantiate that with data. The larger will only become larger. Right, so it depends on the risk profile of the person. When you form a portfolio, and I'm getting into the advisor's part, is that the core part of the portfolio has to remain core and solid, and that's more large and proven companies than the other part. The small and to a certain extent the lower part of the mid form the satellite part, right? How much you allocate that will depend on the risk profile. There is merit everywhere. It is always a stock picker's market. And especially when you look at the last 2-3 years, when the market has flowed up in smaller pockets, and you have to be cognizant of the fact that we closed a budget without two words uttered in the budget: defense, PSU. These two words were not uttered in the budget, which just gives me this big thing that it will start getting far more broad-based. Now contrast that to the market before that. While these movement were in pockets, every fund manager will tell you that he or she wants to buy a good company at a good price. There were lovely companies available at great prices. So while the market could be over-allocated and may be overheated in a certain pocket, there is a broader market available at great value. So it remains a great time to give money to fund managers. It remains a great money to buy the index also. At this moment, I feel for the next 10 years, the investor is spoiled for choice. I mean, for guys like us who would sit foolishly and say equity is an asset class, greater asset class, last 10 years, commodity is almost there, right? Almost ahead of it. That brings down the merit of the multi-asset funds, right? So if you want to diverge away from there, maybe the multi-asset and the multi-allocations can be great stories going forward, but I won't move out of my core. I might bring down the core. Say it is 60 earlier, I would bring it down to 30, 40 and go into these stories. But the core has to be the solid companies.
And which explains why maybe you guys are restarting or upping the limits on one of your funds.
Yeah, we are opening the large and mid-cap fund, the erstwhile emerging blue chip from the 1st of August. Simple reason, the market has expanded. There are far more ideas available. It is a larger fund. It is a 65-35 large, 65-35 mid. Having said that, with that composition, Mr. Nilesh Surana has given the risk reward to the average. It's a very special fund for us. So we open it from the 1st of August for everything, lump sum, purchase, SIP, because we feel the next 5 years, the market, both on liquidity, market cap and new issues, is set to expand.
Okay, so this was halted for a while and you're restarting it.
Since 2016, this was not open for lump sum.
Okay, and wow, so you reversed an 8-year-old call, so to say.
Yes.
Okay.
Nilesh feels he's okay taking money, so who am I to stop?
Yeah, you essentially facilitate that. Great. Rohin, same question really. So you mentioned that you've asked people to move from flexi or small and mid cap to maybe flexi cap, multi cap, etc. Large cap or index hugging funds, are those a good option, or would you believe a hint of mid cap and small cap flavor would maybe serve an investor better over a 5-year period?
I think definitely the latter. I think every portfolio needs to have some mid cap, some small cap. Now, the vehicle that you choose to do that could be a small cap fund or a mid cap fund. The vehicle that I am choosing now to do it with is a multi cap fund or a flexi cap fund. I personally feel that there's no real advantage that a large cap fund offers. And in any case, if somebody wants to do a large cap fund, I think a passive fund is probably a better choice. But just the fact that you're giving money to fund managers because you believe that they will manage it professionally. They have research teams. They have the ability to identify stocks that could sort of give you returns, right? So you want to give the fund manager the flexibility to do so. And that's the whole point of active fund management, right? Otherwise, why go to them? So if I have to do a large cap fund, then I'd rather do a passive index. But I'd still think the active story is good and here to stay. And I think multi-cap or flexi-cap are better options for the long term.
Okay, very quickly, last quick 30 seconds to both of you. Because of these taxation changes, a lot of people must be thinking, should I book a fund right now or should I not do it? Because now I'm subject to a larger taxation, what have you. So anything on that in terms of an advice, or should it largely be the value that the fund is offering currently, and that should be the core decision? Should the taxation, higher taxation, etc., play a part? Either of you?
I think there's merit in harvesting a little bit every year. So if you've already got sitting on big capital gains, then harvest a little bit every year, so that and this is under the assumption that potentially capital gains tax will only increase in India as it is in developed markets. So you may want to just book a little bit every year. Even behaviorally, from an investor point of view, it's easier because when they otherwise suddenly have a big capital gains to book at some point of time, it may not work out.
So harvest a little every year. Okay. Sarup, any thoughts here?
I redeem if I hit my goals, or I want to buy another asset class. Otherwise, I'll stay invested.
Independent of the taxation structure. Yes. Okay, great. Jaiman, such a pleasure talking. Thank you so much for being with us in the studio. Really appreciate your time.
Thank you for having us.
Neeraj. Thank you for having us.
The pleasure was ours. And viewers, thanks for tuning into this very, very informative episode of the Mutual Fund Show.